the whole time I was reading this, I kept thinking about Charlie Munger. And Charlie has this great quote where he says that if you want ants to come, put sugar on the floor, which is great. But that's not my favorite Charlie Munger quote. You know what it is?
I have a lot of Munger quotes that I like. What are you thinking of?
This is definitely my favorite. He says something like, if you don't understand probability, you're going through life like a one-legged man in an ass-kicking contest. Have you ever read that?
Yeah, that's right.
my
That's
favorite.
right. That's a good one.
It's the best
That's a good one.
You ready to go?
Let's do it.
Let's go. Welcome to episode 2 of Crashes, where we studied the most dramatic periods in financial market history. I'm Daniel Gamboa, and I led investment operations at Divvy Homes, a PropTech asset manager acquired by Brookfield in February. I've worked across engineering, product, and finance at several high-growth startups, and I am based in Houston, Texas.
My name is Matt Harris. I'm a managing partner at D-Mission Ventures and the CEO of a venture-backed startup called Architar. Prior to D-Mission Ventures and Architar, I was a vice president on the Energy Mezz team at the Blackstone Group and a principal at a Silicon Valley-based venture capital company called Draper Associates. I'm based in New York City. And we are your hosts. Today, we're talking about the most terrifying crash in modern history, the global financial crisis.
Okay, I want you to picture this. It's 6:42 a.m., Tuesday, December 5th, 2006. You came into the office early today, but you feel late. The sky is dark outside your window. You're avoiding the glow of your screen. It's not the brightness of your monitor, but what it's showing. You run the mortgage desk at a major bank, and overnight, the index that tracks the price of subprime bonds, the ABX, is down again. U.S. home prices are also down. Housing prices aren't supposed to go down, right? No, not nationally. Not since the Great Depression. Yesterday, you got the latest data on early payment default numbers. So these are borrowers that are missing payments in the first 90 days after they close their loan. It's now in the double digits. You're so worried about this, you rebuilt the model 3 times. Something's got to be wrong. It's not. The model was right. Your model spits out $32 billion in losses just for your desk. The air smells of burnt day-old coffee. You're a little nauseous. The realization is washing over you. No one is ready for this. If your book looks this bad, everyone else's book does too. Losses aren't going to be in the millions or the billions. They might snowball into the trillions of dollars across the financial system. A huge number of subprime mortgages are in default, and if the 2004 loans are defaulting, underwriting standards were actually worse this year. They've been substantially worse. A tsunami of defaults is probably coming. The only question is, who's going to bear the losses? You trip over your chair as you run out of the office, looking for the head of the bank's risk committee.
So just to piggyback on what you said and just to really drive it home before we set the stage here, we're about to study a period that has 3 of the top 10 worst months ever in the history of the S&P and has 4 of the top 10 largest bankruptcies in history, right? Just to kind of put a punctuation mark on the intro there about the period that we're about to study. And so what was the backdrop as we headed in to kind of 06, 07, kind of when the market started to crack before things got really, really hairy? A lot of this is shared with our previous episode on the tech and telecom bubble. The one thing that we tried to focus on there was the backdrop is end of the Cold War, right? So I think in the U.S. and the West generally, a lot of the backdrop in the early to mid 2000s was just this feeling of both safety and victory, right? I think that after the Cold War ended and the Berlin Wall fell was the first time probably since the start of World War II, or maybe even the start of World War I, that people in the U.S. felt safe, right? We went through a very long period of just kind of consistent war and threat.
Right.
So it was the first point in a long time where you feel safe. And I think we felt like we had won, right? Like capitalism and democracy had won. One of the things we talked about in the last episode, right, was that this was so extreme that a lot of people were saying that we've conquered the physical world.
Yeah.
And
end
now,
of history.
And now we're the end of history. and now we're going to go conquer the digital world. That was kind of like part of the ethos of the tech and telecom bubble. And like I would posit that 9/11 didn't really change these feelings, right?
Yep.
Having lived through it, curious how you felt, but there wasn't anything about 9/11 that made me feel safe or not like a victorious American, right? Like
Right.
I think that for whatever reason that ethos continued on, even after 9/11 didn't really put a dent in that. Like I don't think there was ever.
Yeah, it doesn't feel like that was the inflection point.
Right.
It's like an event that happened, and like in hindsight, you see it as a data point leading to where we eventually got, but it wasn't the inflection point.
Right. And so one major backdrop to the GFC is still just the end of the Cold War, the end of history, a unipolar moment. Another major theme was just this major theme of deregulation and no regulation, otherwise known as Greenspanism or Reaganism.
Yeah.
One of the ways that shows up in this period, right, is that the Federal Reserve is actually supposed to be the regulatory body for lending standards and for protecting borrowers. And there was a major belief that the lending market, the banking market, will regulate itself. It will be self-interested and not go too far. And that's kind of the way that also showed up in a pretty hands-off kind of interest rate policy. But that ethos of, decreasing regulation and removing regulation as much as possible is a major backdrop as we head into the GFC. General stability, right, which is kind of a part of the end of the Cold War and safety, but I think it deserves its own category.
Yep. The Great Moderation.
Yeah, otherwise known as the Great Moderation, where you had this period, got to keep in mind that coming into the 80s, you have a long period of multiple wars, you have a lot of volatility and inflation and growth and interest rates. And then as you get into the early 90s, interest rates are falling and stable, and you have very high growth. And I think at the time, the idea that you could be growing at the rates that we saw in the back half of the 90s and not have inflation was like a miracle. That's why people use the words new economy, right? And so you had your first sort of real productivity numbers in that time of the year. I think the fourth, major theme kind of in the backdrop of all this before we get into kind of the 2000, 2005 period is just the impact of academia on everything.
Efficient markets.
Yeah, efficient markets, maybe like an overbelief in normal distributions and diversification.
Yeah.
And arguably academia had another feather in its hat, right? Maybe two more feathers in its hat, where you really had two more crises averted. Long-term capital management ended up kind of being a non-event in terms of the long-term and the impact on the world. And then the popping of the tech and telecom bubble was kind of a non-event from an economic perspective. Yeah. Like it was
a stock market event, but it didn't really affect the real economy in a major way.
Right. Yeah. Like the economy, I think it was one of the weakest and shortest recessions on record since World War II. And like, if you think about it, I don't know anybody that was negatively impacted by the tech and telecom bubble versus, I know a lot of people that were positively impacted by it and a lot of people that were negatively impacted by what we're going to talk about here.
Yeah. You weren't losing your house.
Right.
In the dot-com bubble.
And so I think academia and the way that affected kind of the belief that central banks could solve every crisis, and the way that put faith in rating agencies and kind of all the models that they were building on the basis of these academic theories is like a major underpinning as we kind of head into the mid to kind of the early 2000s.
And so you're saying like there's this undertone of safety where everybody's looking at historically over the last 10, 15 years, banks are crushing it. People become complacent. Is that sort of the theme?
Yeah. I mean, I think the impact of that, the way that showed up the most in just like the regular Joe's life is the average consumer is levering up like crazy in this time period, which is part of the reason that you're seeing so much bank profitability. But just to give you some stats, household debt to GDP went from 59% to 96%, 95 to 2008. Debt service went from 5% to 10% of disposable income. And when you look at, that was pretty much all mortgages when you look at the breakdown. Personal savings rate went from 13%, and that was a little further back, kind of in the 80s, to 1% to 2%. And so one of the impacts of low and stable interest rates and a feeling of safety was just this unprecedented levering up of the consumer.
Yeah. So with all of that in mind, So you and I aligned, and I'm just going to put it out there for context for anybody who's listening. We're going to break this up into 2 parts. So part 1 is going to cover the housing bubble, which is kind of the underlying fundamental bubble that ends up creating a big mess that then turns into a major banking crisis, which is going to be part 2. So that's going to be the structure of the conversation. So today's episode is going to be part 1. We're going to talk about the housing bubble. And with that in mind, the place I want to start is one of the most fundamental parts of American life, the mortgage. Okay, so let's set the stage a little bit with some context about the history of the mortgage. In the U.S., before the Great Depression, most home loans were actually short-term. So these were balloon loans. You basically had mortgages funded by local banks. The banker knew you personally. You knew him. They would lend you the money if they thought you were money good. The money came from depositors. So someone who has an account where they deposit their savings. So if you've seen It's a Wonderful Life, you have this local bank, people deposit their money, and those savings are used to fund mortgages and other loans. As a side note, these banks come to be known as savings and loans or S&Ls, and they're going to play a key role in setting up the global financial crisis later on. But for now, in the Great Depression, you would basically pay interest for 3 to 5 years. Then you would refinance and you'd get another loan to pay back the first loan, and you'd roll over the debt. All of this blew up with the Great Depression. This all gets completely restructured, completely changes. Banks were shutting down left and right, foreclosures everywhere. Half of all the home loans in the U.S. default. So just think about that. Like half of the home loans in the U.S. default during the Great Depression. Property values collapsed by 30%. Because of all of this, FDR nationalized housing finance in the 30s. So through the New Deal, set of policies, they created what was called the Homeowners Loan Corporation in 1933. And this was a government entity that bought delinquent mortgages from lenders and refinanced about 1/5 of all mortgages into something more similar to what we're used to today, into fixed rate 15-year loans. Then in 1934, they created the Federal Housing Administration, and there are a couple of big problems that they were trying to solve. One, there was a flood of foreclosed homes on the market, and then on top of that, no buyers could get loans because the banking system had collapsed. So that created a downward spiral in housing prices that exacerbated the banking crisis. Not only did their borrowers default, and the banks had to foreclose, but the value of their collateral was in free fall because there were no buyers. So the FHA insured mortgages against default, and they introduced a set of underwriting standards for mortgages. So they also established the Federal Home Loan Bank Board, which was like a mini Federal Reserve for S&Ls. So if they were running short of deposits, they could borrow from this board to fund mortgages to prevent a liquidity crisis. All of this had the intended effect. So if you were a lender, you now had a clear set of standards to price risk. If you followed them, you effectively shifted the risk of default to the federal government. Down payments go from 30 to 50% to something more of what we're used to today at 10 to 20%. And the repayment timelines on the loans go up to like 15 to 30 years. So now you're actually starting to see the market structure that we're kind of all familiar with today. All of that gets built during the Great Depression. Then in 1938, they created the Federal National Mortgage Association, also known as Fannie Mae. So here's where Fannie Mae comes into existence. So the goal with Fannie was to create a financial institution that allowed the government to buy mortgages from the S&Ls and other banks that originated them, so that in turn it would let the S&Ls replenish their capital base and be able to underwrite more mortgages. So think about it this way. So if you were a local bank, someone came in, wanted a mortgage to buy a house, they had a steady income, they had a history of repaying their debts, you gave them a mortgage, so you originated the mortgage, you created it. Now you expect it to receive interest payments, and then you'd get paid back at some point 15 to 30 years. But that's a really long time, so you can't put that capital to work while you lent it out. But if you sold that mortgage to Fannie, basically Fannie gave you back the money that you lent, and now you were able to go back and lend it out again. And so Fannie owns the mortgage. So, a couple of key terms that we'll keep coming back to. One, originators. So originator in this context is the primary market. It's where the mortgage starts. And then the secondary market, which is where Fannie lives and breathes, they don't underwrite the mortgage, they buy it from the originator. It's basically an investment. Interestingly, I think it's important because this is going to come into play later. That secondary market basically sets the underwriting standards for the originators, right? Because if you don't have a buyer for your mortgage because you didn't meet the standards that they're willing to buy, then you can't offload that mortgage and then replenish your capital. And so the underwriting standards that the secondary market is willing to invest in is what sets the standards for the broader mortgage market. So back to the kind of history of it, all pretty clever. The good news was that the more mortgages there were, the more demand for housing, and the more houses were built. That created jobs, which was a key goal of the New Deal. All of this also created basically a higher rate of home ownership and more affordable housing, which is another key policy goal of the New Deal. And so everything's kind of working together. Things are moving in the right direction. Then as World War II was coming to an end, Congress passed the GI Bill in 1944. Among other things, it introduces the VA loan. Now the government is providing a guarantee of about 50% of the mortgage amount. So if the veteran can't pay it back, the government paid up to half to the bank. So it reduces risk pretty massively. Meant that the lenders were ready to finance this huge wave of borrowers as people are, coming back from the war and starting families, and it fuels this massive building boom in the post-war era. By 1966, about 1/7 of all new homes in the U.S. were financed with a VA loan, so a pretty substantial part of the market. Home ownership rate in the U.S. goes from 44% in 1940 to 62% in 1960. And the 30-year fixed-rate mortgage becomes the preferred financing product for Americans. So much of how the history of this market unfolds from about 1940 through the 70s and then, subsequently to the 80s comes from what happened in the 30s. So again, we're barely scratching the surface. This is kind of a high-level overview, but all of this history on mortgages is super important to set up what came next after all of this, which is, of course, one of our protagonists of the GFC, which is the mortgage-backed security.
So before we dive into MBS specific stuff, just a couple of things to riff on Fannie and Freddie and the New Deal and all that stuff. One major thing that stood out to me in this study is what can happen when you have long-term bipartisan support for something in the U.S., which is super uncommon, and this actually made me appreciate how uncommon it is.
You mean home ownership?
Yeah.
Yeah.
So home ownership, since really the New Deal, at least, has been viewed as foundational to democracy, basically. And I was thinking about why that might be, and it makes sense, right? You give people a stake, real ownership in the country, through home ownership is kind of how I think about that. So the whole point of creating Fannie and Freddie was, in my opinion, to support low income and middle class housing, right?
Yeah.
And that has been something that both the left and the right and the center have they had 100% of their support behind this, basically from 1938 to 2008. So you had long-term bipartisan support. But one thing that stood out to me too is there was like an enormous amount of political angst around the setup of Fannie and Freddie.
Yeah.
And what I mean by that, right, is that Fannie Mae was originally 100% government-controlled entity, right?
Yeah.
Like they weren't a public company or anything. And they got spun out into a public company in 1968 for sort of two specific reasons that are related to each other. One is that at the time, every mortgage that Fannie Mae was buying was actually a government outlay, and so it was adding to deficits at the times of guns and butter, when deficits were sort of ballooning and becoming an issue. And at the same time, you had the baby boomers kind of coming of age and wanting homes. And so you had this thing on the government balance sheet that was creating huge deficits, while at the same time that it was clear the deficit was going to get much bigger if they wanted to support housing for baby boomers as the population of homeowners increased in like a huge way. And so they actually spun Fannie Mae out to be a public company.
Yeah, I have a stat for you. So do you know what the growth rate was in population from 49 to 64? This is as the baby boomers are entering the market.
What was it?
It was a 50% growth rate. So 76 million people born in the U.S. between 49 and 64. So in less than 20 years, the population of the U.S. grew by 50%. And these are all the people that are going to go into the housing market and kind of start families, start households.
Right. Yeah, the backdrop of demographics has been really interesting so far in this study. One of the things that stood out in the demographic study of the tech and telecom bubble that didn't really talk about and is a little maybe charged but the amount of immigration that was happening in the 90s to fill the roles needed in the tech space was like clearly a huge part of the tech sector's success in that time period. Specifically, the tech if you think about the growth we had without creating inflation, that has to be one of the top 3 reasons that that was able to happen. Anyway, so the government spins Fannie Mae out into a public company in 1968. And so now you have this weird entity that we know as a government-sponsored enterprise, or a GSE.
Yep. And they kind of broke it up into 2 things, right? They had like the whole concept of VA loans and FHA loans gets spun out into its own entity, and Fannie is really there for conventional mortgages, right? In the 1968 Act.
Right. And then you had Freddie Mac come along, which was actually created in 1970 for the interesting reason of creating at least a duopoly in this market. My read of Freddie's purpose was to create competition for Fannie Mae and to focus specifically on smaller savings and loan and thrifts in terms of which mortgages they were buying. But so they were immediately they were a privately held company when they were created in 1970, and then they went public in 1989. And so you have these 2 very strange entities out in the world that have tax breaks and super low interest rates because they're, people believe that they're government guaranteed, right? There's an implied government guarantee, even though there's not a real one, right? Did you see anything that suggests there's a real one?
And that's the key part of all of this, is that the market expects that if they ever get in trouble, the government is there to backstop them. But it's implicit. There is not an explicit or legal guarantee that the government is there to backstop them.
Right. And I actually think I would have thought the same thing at the time. When you think about how important, I think housing is really important. And I think I read somewhere that the GSEs guaranteed about half of the residential mortgages in the U.S. Mm-hmm. And so the idea that they were going to be allowed to go down was pretty much unthinkable. That being said, there was an enormous amount of political angst over these GSEs, in the 80s and 90s leading up to the great financial crisis, for the simple reason that they were crushing it, right? The execs at these companies were making huge salaries and bonuses. The shareholders were getting super rich, and it was all because of not solely because of, but largely because of the fact that they had tax breaks and low.
And the implicit government guarantee basically meant that they could raise money much cheaper than anybody else doing the same thing, right?
And they had no competition in what was becoming like a huge market, which we'll get into it, but Wall Street is looking at this and just salivating, right? They're saying, like, why did these GSEs have a duopoly in this huge market that we understand?
It's an unfair advantage, to some extent, or at least that's the argument.
And so there's a lot of history of trying to reform the GSEs in a way, but the summary of what I'm trying to say here is that the bipartisan support for home ownership won every time, right? There was no change because there was so much the bipartisan support for home ownership in the low and middle income classes was so strong that there was nobody ever touched Fannie and Freddie.
Yeah.
And then also worth noting that there is this third entity called Ginnie Mae, which is a little different in that they are and have always been 100% government owned and controlled. And what they do is they actually they guarantee mortgages, so they don't buy mortgages or make loans. Rather, they guarantee. Anyway, so I think that history of Fannie and Freddie is really interesting, and like you pointed out, in the bear market of after the tech and telecom bubble burst, they also did super well. I think they were actually up in the bear market years. And so the history of mortgage-backed securities from a high level is an interesting history of, when you think about it from a product perspective, right? It's a zero to mass market history. It's a case study in how you get more people to buy something. This market went from 0 to 5.4 trillion in 20 years. Which is half the size of the stock market, which has been around for like before the Civil War.
Yeah.
And so you have so it's an interesting to track, what caused this market explosion. And so the first mortgage-backed security, interestingly, I can't really make sense of this, but the first MBS was actually issued by Ginnie Mae in 1970. And then, my read of it was that there was a major inflection point around the savings and loan crisis for this market. So the savings and loan crisis, we'll study that in a future podcast, but it's when you look at it from a bank failures perspective, we talked a little bit earlier about how 2005, 2006 are up to this point. I think 2018 is the fourth or around there, where there were no bank failures in the year. But 08, 09 stand out as huge bank failures, but the number of bank failures was small. But the deposits and the asset bases of these banks was huge. The S&L crisis is almost. You look at it on a chart. From 1982 to 1992, you had more than 100 banks failing every year. You had 5 or 6 years of kind of 300 to 500 or more banks failing a year in the S&L crisis. And so, what happened here was that interest rates went up and banks got caught, borrowing short and lending long, and they ended up.
This is the Volcker period, right?
Yeah.
So the interest rates have shot up to fight inflation.
Right.
Is that right?
Right. And so they're paying more on their deposits than they're receiving on their mortgages, and so a ton of banks fail, and that resulted in one major change, which is the removal of interest rate caps. Right. It became and this was through government action. It became legal to issue mortgages that reflected higher risk, so at higher rates. And the whole purpose of it was to stabilize the banks and make it so that they didn't have to take quite so much interest rate risk by offering floating rate mortgages.
Yeah, because you're basically the banks were basically having to pay market rates, which were now north of 10% to depositors, but they could only charge like 5 or 6% or something like that, right, for their mortgages.
Right.
So clearly not profitable.
Right. And so this was clearly the right thing for banks, but you can kind of see how it sets the stage later on for adjustable rate mortgages, which were a huge part of the subprime crisis later on. There was also a little bit of an ethos, if you think about the timing here in kind of kicking off the early 80s into the 90s. It's really the same time that the high yield market is getting going with Michael Milken and all these guys. And there was a similar ethos in this market, as I understand it, where the ethos in the high yield market was, every company should have access to credit. The ethos in the mortgage market was, every borrower should have access to mortgages.
Yeah, you should be able to price risk adequately so that if somebody's willing to pay that, you can get credit.
Right. And a big part of this that I think you probably have a better handle on is the way that mortgage-backed securities balanced out the U.S. market, right? Specifically in the S&Ls, where you had certain banks and thrifts that had like access to a lot of deposits, but maybe not a lot of demand for local mortgages.
Right.
And the mortgage-backed security made it so that you could sort of transfer.
Yeah, because basically, at the time, before the S&Ls really get in trouble, at the time, you're basically relying on your local bank to give out mortgages, which is a very constrained pool of capital. It's very geographically constrained. Whereas with the MBS market, you basically have a universal pool. You have a global pool of capital that if you can match, the capital of the world and channel it into a mortgage market, then that's a way more efficient way to do it, right? Because it's not like you can have pools of capital in, Texas or California specifically for mortgages at all times versus having the global capital base available wherever you might need it for mortgages as different housing markets are, higher or lower demand, right? You can kind of have a on-demand shifting of the capital base wherever it's needed.
Right. And so one of the things I thought on that point was you're again getting sort of academia showing up here. And one thing we haven't stressed enough so far in this podcast that was really a big part of the backdrop, and that's worth mentioning here, is just the general sentiment that housing prices only go up, right?
Yeah.
That was like a major undercurrent of this time. It was really two things: housing prices only go up, and especially housing prices never go down on a national basis, right? If housing prices were somehow to go down, it would be regional and not national. And so some of the ways that the mortgage-backed securities, enabled the market to grow by matching supply and demand across the country. There's sort of the undercurrent of academia is clearly there, right? Like, oh well, I don't know the borrowers in Idaho, but as long as you're offering me 50 of them, then it's okay because I'm diversified. Is kind of the underlying current.
Yep.
One thing I learned that was interesting in this space that I think made mortgage-backed securities and taking out mortgage debt just kind of increased the whole market size was that in this time period, I guess credit like consumer debt used to be deductible, just like mortgage debt is. And so they removed the deductibility of consumer credit from income, and that just made the mortgage market more attractive to everybody, right? So I thought that was kind of an interesting fact.
Yeah. One of the really interesting things about MBS is that this goes back to the whole ethos of regionalization and diversification and access to global pools of capital. But when you're building a mortgage-backed security, what you're basically doing is you're taking a bunch of mortgages and you try to make it as diverse as possible. So you might be taking mortgages from Texas and California and New York and other states, and you're putting them together into a pool of mortgages, and you're breaking it up into slices, almost like you can almost think of it like a company having shares, right? Like you have fractional ownership of a pool of hundreds of mortgages, and that's a mortgage-backed security. You have like a share of this stream of cash flows that's spitting out from these mortgages that people are paying. So you don't have concentrated risk on a specific mortgage in a specific place. You have diversified risk across a really widespread pool of mortgages.
Right. And one of the so we talked a bit about how the history of mortgage-backed securities is a case study in getting more people to buy something. I think one of the major innovations in this market that got more people to buy something is the tranching of mortgage-backed securities.
Yeah. Mm-hmm.
Right. And so what we mean by that is, say you've got 100 mortgages, people are looking at that and saying, oh, that looks pretty diversified. Housing's pretty safe. We'll talk a little bit about, the yields on mortgages versus other safe liquid debt instruments. But now the tranching of it made it even more attractive to buy mortgages, where they created essentially a waterfall where there'd be different classes that would receive those mortgage interest payments first, essentially. And so the top tranche would be made whole before the second tranche got any of the coupon, before the third tranche, before the fourth tranche. And so you had this kind of increased level of safety, because not only were you in a diversified mortgage product, but you were in the first tranche or the second tranche. And therefore you were going to be made whole before the fourth or fifth tranche. One thing I think was a major factor, because one of the things that sort of created a dissonance in my mind as I studied the failure of banks is like, well, why do banks have all these mortgages, right? If they're just buying them and creating mortgage-backed securities to sell to other people, then why do they have all these mortgages on their balance sheet? And I think one major factor that comes into light when you look at the tranching is that they were having to hold a lot of the lowest tranches in their inventory, right? Because those, for obvious reasons, had the least demand, and they were securitizing mortgage-backed securities to themselves in a lot of the cases because they had their own hedge funds and things like that.
Exactly. And this is going to play great in part two when we talk about collateralized debt obligations, right? Because they're trying to figure out what to do with those lower tranches, and they end up repackaging them and creating securities from securities from securities. But I think we should also talk about, there's two guys that I think are pretty prominent, one of whom is still very active and I think a lot of people will know about, but two of the main architects of this whole mortgage-backed security ecosystem after Ginnie Mae comes out with the first MBS and Fannie and Freddie are doing this. The guys on Wall Street are trying to figure out how to get into this game. And I assume at some point you've read Liar's Poker from Michael Lewis, his first breakout book. So there's a character that is key in all of this, one of the main architects of the MBS market as we know it, Lou Ranieri from Salomon Brothers. And he's definitely profiled in that book, and it's a fantastic book. Here's a guy in like the old kind of Wall Street where you could still start out in a mailroom and sort of climb your way up to the top of one of these firms, and that happened multiple times. That never happens today. You can't even get in if you don't have a degree from a big university. But anyway, Lou Ranieri, bit of a Wall Street legend. He headed the mortgage desk at Salomon Brothers, and he figures out how to kind of create structure in this market. And then the other guy is Larry Fink, who at the time was the head of the mortgage desk at First Boston. Of course, now he's the founder and CEO of BlackRock, which is the biggest asset manager in the world. But Larry Fink is credited with coming up with this architecture of tranching. So, right, MBS originally was just a securitized pool of mortgages, but there were a lot of problems with it because people would prepay, you had to hold it for a long time, and you were realizing this yield, but what if interest rates changed? And so I think what was really interesting about as the market develops with Ranieri and Fink kind of working on this stuff and architecting these things is that tranching allows these mortgages to be more sophisticated and to sort of be more bespoke to what specific investors might be looking for. And of course, the rating agencies will have a big part to play with. But these two guys have a big impact in creating this market.
Yeah, interesting. I actually remember that now, but I had forgotten that Larry Fink was involved.
Mm-hmm.
It's always interesting to kind of track the main characters in Wall Street today back to this time.
Yeah.
Wasn't the guy who founded Long-Term Capital Management was from Salomon Brothers as well, right?
Yeah.
So this is sort of a
the main
major
operator.
source of financial innovation.
That's right.
I think that maybe caused some problems.
Yeah, and they like one of the first things that they did is getting the rating agencies involved, which was critical because that's going to play a big part later. But the complexity and the sophistication of these products was such that a lot of investors needed a little bit of hand-holding. I have a quote actually from Ranieri. He said, "You need to impose structures that were relatively simple for investors to understand so that they didn't have to become mortgage experts." Right? So basically what he's saying is investors are not going to be able to diligence the individual mortgages, or at least that's the thought. They're not going to be able to diligence these hundreds and hundreds of mortgages, these tranches with different risk profiles. Most of them probably wouldn't even try, but let's just assume kind of positive intent. They just weren't experts, so they just couldn't diligence these. And so if you had a rating agency that gave the securities a high grade, then as an investor, you kind of take that for what it's worth, and then you move forward with it. You sort of trust in the implicit diligence that the rating agencies bring to the table. And that's true. I mean, that's even true in the markets today, right? Like there's a lot of players in the market that are less sophisticated, managing big pools of capital that rely on others' research to make investment decisions, for better or for worse.
Right. And so that, to me, the bringing in of rating agencies in the story of mortgage-backed securities is just another feather in the cap in terms of getting more people to buy your product, right? And so the thing that showed up, the thing that really stood out to me with the rating agencies and where this was all going was the market became overly reliant on ratings for the very understandable reason that they couldn't diligence 5,000 mortgages in a mortgage-backed security and like where their coupons were in the seventh tranche of the mortgage, of the vehicle.
Right.
So they started relying on rating agencies. I mean, rating agencies are really interesting organizations if you think about it. They're like Moody's and S&P and Fitch and a handful of other ones are actually SEC certified to rate stuff, right?
Yeah. And the history, you know the history of them? Like the history was that they were rating corporate bonds.
Right.
Like that was the history, and they actually dismissed this market altogether when Ranieri, Fink, and other guys were bringing this up and trying to create this whole market. They actually dismissed it as like, well, this is not what we do, and we are we rate corporate bonds. And in a way, if you think about it, like for anybody who's had experience, and you obviously have a ton of experience with that, a little bit simpler than having to like slice and dice a bunch of mortgages and figure out what's the underlying risk and how do you properly price that. But this became their bread and butter. Like this became not just a very profitable part of the business. This became almost half of their revenues by the time you hit 2006.
Right, and I didn't appreciate that. Another thing to look out for is that the rating agency's original business model was subscriptions from investors.
Yeah.
Right, so they at some point they switched to charging the borrowers, which is a massive conflict of interest. And I thought it was interesting to learn too that so Moody's went public in 2000, and their market share of rating mortgage-backed securities went from 43% in 2001 to 73% in 2002. And my quick math was that these rating agencies were making about 7 basis points per mortgage-backed security rating, which they were doing in about a day. And so they're making, $500,000, per day.
Very profitable.
To rate these mortgages. And the thing that stands out to me when you look at how they were working on it is they didn't have any data on how mortgages perform when there's a nationwide decrease in mortgage prices, because it had, I think it had happened once in like the 60s or something, but there just wasn't any recent data on it.
Yeah. Well, and there wasn't any data, I think, that was correlated across the whole, like there wasn't, post Great Depression, there was not a single period in the U.S. where every single housing market went down at the same time.
Right.
And of course, like the data set is limited because if you go back to the Great Depression, it was a fundamentally different market.
Right.
A fundamentally different mortgage market.
And you especially had no data on subprime and how it was going to
Right.
perform. Subprime was a new and huge part of this market. And so my favorite thing that I read about like how the rating agencies were dealing with this, right? Because these are public companies that have to make a profit and compete with each other. And they had this issue of like, how do we deal with figuring out what the correlation is given we don't have any data?
Right.
And their answer was the combination of using the prices in the CDS market, right, which also had no historical data. When we'll talk more about CDS.
We haven't talked about CDS. Yeah.
And then they were using this thing called the Gaussian copula to think about. Did you come across this at all?
I did, yeah.
To think about how correlations would play out in the market. And the Gaussian copula is actually something that's used to link the likelihood of death between spouses after another spouse dies. Right.
Yeah.
And so like they're kind of reaching here is kind of my summary for like how they're trying to figure out how.
I was not
how
expecting that we were going to talk about the Gaussian couple today.
And so kind of rounding out the conversation on mortgage-backed securities, in the 80s and 90s, you had a very clear duopoly in the market with Fannie and Freddie, really owning this market and doing very, very well as a result. And you had, Wall Street's clearly in the game because it's a debt market, and they're around, they understand it. And one of the major things that changed in this market in the early 2000s was the growth of what are called private label mortgage-backed securities, where you had the banks getting much more involved in mortgage-backed securities. Their market share of...
It was fairly small though, right? For this time period? For like 80s and 90s,
it
was
small.
Yeah, it was really small, and they were actually mad about it, right? Like,
exactly.
This is the whole point of they couldn't compete against these government-sponsored enterprises, so, Fannie and Freddie.
Yeah, so I have in 2000 the market share of mortgage-backed securities was 22% investment banks, and everything else was the GSEs.
Yep.
And they didn't like that, right? Because this is a big, super lucrative business,
right? But they couldn't do anything about it because investor demand was like, well, I want that implicit government guarantee,
right? So one of my questions on this is their market share of mortgage-backed securities goes up to about 60% over the next 5 years. And one of my questions is like, where did the buyers stop caring about the government guarantee?
Well, Fannie and Freddie couldn't guarantee subprime. Well, actually, not even subprime. They couldn't guarantee anything other than conventional. Right, so you had Ginnie Mae doing the FHA and VA thing, but they had an explicit government guarantee. Fannie and Freddie could not, but like statutorily participate in the market below conventional mortgages, and so it was wide open for the Wall Street banks to sort of own that market.
Right.
Yeah. So I think what I want to actually go back and talk a little bit more about the tranching process, because I think it's pretty critical to understand this. Did you by the way did you read or did you read The Big Short or watch the movie for this?
I didn't reread or rewatch anything that I watched in the past. So I
did both because I
maybe should have.
Yeah, it's a fantastic book. It's a great movie. Of course, they have Margot Robbie describing some of these,
and Ryan Gosling,
and Ryan Gosling describing some of these things. We're not going to have that today. It's just the two of us. But so anyway, let's dive into the tranches one more time. I want to double click on this a little bit, and so I want to actually simplify it a little bit and say you have this concept of a collateralized debt obligation or a collateralized mortgage obligation, which is a way to tranche the mortgage-backed security effectively. And you can think of these tranches as having different risk profiles and think of them almost like a senior and a junior tranche. These had a lot more tranches. It wasn't just two, but just for simplicity, think of it as having like a senior and a junior tranche. And investors in the senior tranche are going to get all the principal repayments from the borrowers until the portion of the principal is completely paid back to them before the junior tranche starts getting paid payments. And so the senior tranche might get paid back in about 5 years. Maybe the junior gets paid over the course of the full 30 years. But either way, the most senior tranche is going to get paid fastest and first. And so, of course, when you take this to a rating agency, especially on a pool of mortgages that are all conventional and it's broadly diversified, geographically, that's going to get rated AAA. And the concept of a AAA rating is basically as safe as government debt, right? Like it's the probability of default that's practically zero. Like you're not going to lose money by investing in a AAA rated security, which is what these senior tranches of CMOs were getting. And so, with the rating agencies on board and these tranches are in place, Ranieri and Fink basically take this market and start growing it massively. So I saw a stat that said that Ranieri's mortgage desk at Salomon Brothers in 1983 was responsible for half of the revenues of the whole bank. So $415 million at the time. So, pretty huge. And I think at this point, when you think about that concept of a CMO with these senior and junior tranches, at that point, the modern mortgage machinery was in place. That is the market that is going to evolve through the global financial crisis that kind of started in the 80s and really grew, in the late 80s and 90s. So you had these local originators that were sourcing borrowers for mortgages. You had Fannie and Freddie that basically had a duopoly, like you were talking about, on buying and securitizing the mortgages. And then you had the Wall Street mortgage desks that, along with the rating agencies, were structuring these into CMOs and attracting these massive pools of investors with a very bespoke product to buy into, right? And on top of all of that, they're offering interest rates that they can't get anywhere else. They're offering much better yields with a much higher rated security.
What did you see on that, on credit spreads? And because it's interesting to take a second and just talk about why mortgage-backed securities were so attractive to everybody.
Yeah. So the credit spreads themselves move around, right, over the course of the decades through the 80s, 90s, and into the global financial crisis. But I think what's interesting is that the mortgage-backed securities always had an advantage in that you're earning more relative to what you could earn from a U.S. Treasury with the same exact credit rating. And that's what made this thing universally attractive to, investors all over the world, is that you could earn tens of basis points more by investing in these things for the same level of risk, effectively. And it's not like the U.S. Treasury market is massive, and so you had overflows of capital looking for yield, and this was a perfect way to do it, to invest and get more yield for complete safety.
I also wonder, in the specific time period of kind of post-tech and telecom bubble to, say, 2005, 2006, where, one thing we haven't talked about that we'll get into is just the surplus of savings among certain countries in the world and where that money was going. But, maybe one way, for example, 9/11 sort of changed the trajectory of things is that you had a little bit of a, maybe just like lower risk appetite is the way to think about it, where there was a demand there, not so low that people didn't want to risk their capital, but low enough that they didn't want to buy tech stocks anymore. Rather, they were looking for, yield, right? It'll be interesting as we do more studies and to uncover, was this the first sort of global search for yield period ever?
Yeah.
Where you had just everybody that had excess savings, instead of wanting to take risks on the stock market, now they're really just wanting to find the best risk adjusted return in the yield market, which arguably is mortgage-backed securities at this time. Yeah.
I think the only other thing I would add is taking it back to Fannie, because I think they're such a critical player to build this up. If you think about the market construction that's going on, in mortgage-backed securities on Wall Street with Larry Fink and Lou Ranieri and these guys, their key partner on all of this is Fannie itself. Because at the time, especially in the 80s, Fannie was in a bit of trouble. And there's this guy that gets appointed CEO, this guy David Maxwell, who was a Yale graduate, Harvard Law School, Republican turned Democrat from California, businessman, very smart, very described as a very charming guy, incredibly competitive and intense. And he comes in guns blazing into Fannie to transform the culture. And he's described in one of the best books I read for this, doing research, All the Devils Are Here. Fantastic book by Bethany McLean and Joe Nocera. He's described as a transformative figure. He did not tolerate mediocrity. He could not afford to. He was fighting for the survival of the company. And so, I want to kind of emphasize that Fannie was not a government bureaucratic company, right? They had an implicit government guarantee, and historically they had been a government entity, but they weren't anymore. And they really operated as an intense, like the kind of intensity that you might expect from a Wall Street firm, but they were in DC. And so they are one of the key partners in all of this to get this market off the ground, to get the mortgage-backed security market off the ground, despite the fact that the Wall Street firms actually want to compete with them and want to take market share, but they can't because investors generally want the Fannie and Freddie guarantee. Okay, so to recap a little bit, so they solved, by creating this market, they solved the problem of expanding the capital base available for mortgages by creating a mortgage product that appealed to a massive investor base. But there's kind of two flaws with the way that this market was architected. And, you might have come across this or come to the same conclusion. Tell me what you think. But anybody listening probably has who spend significant time or significant amount of time in mortgage markets probably is screaming this right now into their headphones. Two things. One, originally the community banks actually got to know you, right? And so when they were underwriting a mortgage, they knew exactly what they were underwriting. They knew, that you were money good. If they made a bad loan, that was their own money on the line. And by this point, by the 80s, that's completely decoupled. That's gone. The person or the firm that originates the loan is not going to hold it. They're originating the loan to generate fees, and their goal is to sell it. And your only constraint really is the underwriting standards of the secondary market that's going to buy that loan from you. But to you, it's just a transaction, and you're moving on. So that's one flaw. And then the second problem is, like we talked about, Wall Street's a bit frustrated, and there's a giant and growing, very lucrative market, and they're kind of stuck playing second fiddle to Fannie and Freddie, to the GSEs. So the only way that they could expand their profitability, and you mentioned this, is that they needed to find a segment of the market that Fannie and Freddie couldn't participate in. So they would definitely find it. I want to go back to that first point of origination. So origination becoming decoupled from holding the mortgage. So you mentioned that the SNLs were blowing up in the 80s, and there's this new type of originator on the scene, not banks at all. They're just set up to specifically underwrite mortgages, find borrowers, underwrite them, create mortgages that were attracted to the GSE, sell them, and recycle the capital so they could do all over again. They were not interested in mortgages as an investment, right? They were interested in the origination fees. They wouldn't be able to offload those mortgages unless they underwrote based on what the GSEs wanted to buy. So that was key. That was kind of kept keeping everything in check. And to put the rise of these non-bank originators into perspective, they went from nothing in this market to 19% market share by 1989. And by 1993, they had 52%. So, the origination concept and that sort of market structure is dominant by the 90s. So because of the way the market worked, there was not unlimited growth. Like, this isn't a tech product that you could just keep growing, and have like a global base. You were constrained by the size of the housing market in the US. And so it was all about market share. That was the only way to grow, is that you needed to outcompete everybody else. And it was a bit of a commodity, so margins are really tight. Interest rates are out of their control, right? They don't control interest rates, so they don't control their pricing, what they can charge. They don't control their fees because, again, very competitive. So the goal is just taking as many borrowers as possible from that constrained pool. They needed to be able to find as many qualified borrowers as they could. The business eventually moves into kind of an independent broker type model. Basically, the people finding customers to originate mortgages are independent of the company. They're contractors. They're not full-time. And of all these originators, Countrywide grows to be the biggest. So by 1992, they're writing $40 billion in mortgages every year. They focused exclusively on tight underwriting that adhered to the GSE so that they could sell the mortgages fast and move on. And this was a bit of a point of pride for them. So Countrywide was this lender that held really high standards. Of course, this is all going to go away later. And they're one of the main actors during the collapse. There was another originator, though, that was not like Countrywide, and that was targeting a different segment of the market. And these were people that didn't qualify for conventional mortgages. So maybe you wanted to buy a more expensive house relative to your income, or maybe you were in a part of the country where the houses are really expensive. And so historically, this was a pretty ugly part of the market, very predatory. You had a lot of sharks that charged pretty onerous terms, high fees, really high interest rates, extra collateral, They pretended that they were making up for the incremental risk, so trying to price the incremental risk, but in practice they were just very predatory. They were just taking advantage of people. And at first, these guys aren't writing first lien loans. Usually they're doing secondary mortgages because first lien didn't make sense for them to compete. But eventually they do move into that kind of subprime market. This is where really that market comes to life very early on. They start coming up with very creative structures. So you could borrow with an adjustable rate, balloon payments come back. Basically, non-traditional mortgages that might help more people qualify for mortgages, right? You couldn't qualify for a conventional, but here's all this creative structure that might help you. So as these subprime mortgage originators are getting into the market and kind of getting started, there's what you talked about earlier with homeownership. And just to put some stats down, so homeownership rate in 1980 was almost 66%, but by 1991 it was down to 64%. And so there's also this underlying trend of policy coming out of Washington encouraging homeownership. And because of all the deregulation, financial deregulation that had started in the 80s and was definitely playing out through the 90s, there's also another force, another wave that these subprime mortgage originators are surfing, which is that there's an element of, hey, let's creative and let's try to get as many people into houses as possible. And so naturally, these people that were already taking advantage of a market that was kind of inefficient and maybe executing with some pretty questionable practices on a lower income segment of the population, that policy kind of feeds into that frenzy. And there's going to be kind of a wave of subprime growth in the 90s that's not going to lead to a crash, but it's definitely going to grow. And it's going to set a little bit of the infrastructure that comes later into the 2000s.
One thing we haven't really talked about is what was the Federal Reserve doing during all this time? So first of all, you still have Alan Greenspan as the head of the Federal Reserve until 2004, 2006. Do you remember which year it was?
06, I think is when Ben
yeah.
Bernanke came in, yeah.
And so we're coming out of the tech and telecom bubble bursting, where the Fed cut rates from the low fives all the way down to about 1, which when you look at that on a chart, rates hadn't been that low since the 60s. So you're kind of at a very kind of all-time low. And the thing that stands out to me about this time period leading up to the most dramatic days and months of the GFC is that nominal policy rates stand out as super low, especially when you look at it from the perspective of the recovery market cycle, right? The way that I look at interest rates for a time like this is, how did the Fed funds effective rate during this time compare to previous recoveries, right? We talked about how this is the longest recovery period on history since the end of World War II. So when you look at Fed effective rates during this recovery, they averaged about 2.8%. The recovery was from October 2002 to May 2007. And if you look at the average of Fed rates during previous recoveries, it's 5.74%. For all periods, all recovery periods back to the end of World War II, and it was actually 7.11% for the prior 5 recoveries. Right, so you have a very low nominal policy rate on average for a period where the economy is recovering, healing, getting back to growth after a bear market and likely, in this case, a very slight recession. Real rates actually stand out even more. So real rates in this time period, which I'm defining as 10-year Treasury minus annualized CPI, they were about 43% of prior periods. And you got to keep in mind, too, that most prior recovery periods were much, much shorter, right? So on a nominal basis and a real basis, you had very, very low interest rates during the recovery period, kind of heading into this was a huge contributor to what inflated houses. And remember, we said this in the past, this was intentional, right? The Fed was trying to have housing lead us out of the bear market into the recovery, into the expansion part of the market cycle.
Why did that make sense, I guess? I mean, stocks had crashed. They're kind of out of favor. Credit and mortgages are a big asset class. Is that what they're trying to stimulate? I mean, at the same time, I think we had influx of capital from abroad looking to invest in the U.S. Is that the right way to think about it?
Yeah, it's a good question. I think the thing that's in my mind is that the recession following the tech and telecom bubble bursting was just really weak, one of the weakest on record. And the consumer, just kind of going back to what we said earlier, right? Like, we don't really know anybody that was negatively affected by the tech bubble bursting. And so I think the consumer remains at this point in pretty good shape versus, corporate investment is plunging. Business sentiment is pretty bad at this point. So when you look at the personas that are available to juice the economy, the consumer's looking pretty good actually compared to everybody else. And so focusing on the consumer to lead the recovery using mortgages, using home equity loans makes sense in that regard. So you had the Fed keeping policy rates really low. There was another major factor that contributed to ultra low interest rates during the period leading up to the great financial crisis. And it's this thing that's now referred to called global savings glut, and it resulted in what's known as a search for yield. It'll be interesting to uncover as we study other market cycles if this was the first ever sort of global search for yield, right? Like the global financial markets are pretty mature at this point. Was it even possible to have a global search for yield before this point? Probably not.
Right. Do you know who coined the global savings glut? Do you know where that came from?
It was Bernanke, wasn't it?
Yeah, it was Bernanke.
Yeah, right.
Uh-huh. Yeah.
And I think one important thing to talk about here is, why was this not a global search for tech stocks, right? Let's just kind of, maybe this is how 9/11 affected the world, right? Like everybody's still willing to be out there taking risk, but they want yield now. They don't want the high-flying tech stocks. They want the yield. What did you come across in terms of like reasons that there was a global savings glut? Did you come across anything interesting?
Yeah, it's all about the trade deficit, right? This is the point where economies, especially in Asia, are pumping exports like crazy, and they've been developing now for a couple of decades, and so they're just flush with dollars. The U.S. is importing a ton. This is very topical, and I don't think we need to get into the complexity of the current account balance, but I think that's the main reason.
Right. So,
and there are massive savings rates, right? Like these economies people are not spending money in Korea, in Singapore, in China.
Yep. So you have high savings countries in emerging markets. So when I think of this, I think about so China and Japan actually increased their holdings of mortgage-backed securities by about 3 times in the first couple years of the 2000s.
Huh.
Federal debt held by foreigners increased by about 2 times in this period, and it's actually up a lot more than that since then. It's a little scary. The things that I noticed for like what caused the global savings glut, they're exactly what you're saying, but it's one, China is a more mature economy. They're sort of entering, I guess, like second world country status maybe at this point.
Mm-hmm. They're
not third world, but they're kind of, remember the BRICS were such a big deal during this time period. But they're still growing at, almost double digit rates. And it's through this export led economy. So they're generating a ton of savings. You also have, the Asian tigers, right? The Malaysias, the Indonesias who had a pretty rough second half of the 90s with a bunch of currency crises.
Yeah.
And they have recovered, and their growth rates are pretty good. And these are export-led countries too, but they're still healing from being too aggressive, and so the savings rates are really high there.
Yep.
And the third one was oil prices were crazy high during this period.
Right.
And so you had the oil exporting nations, building up these huge surpluses, and that kind of leads to what I think is another major topic of the first half of of kind of 2000 2005 is this thing called a commodity supercycle. There's talked about a lot during this time period. The way to think about commodity supercycles is it's a very long and sustained increase in commodity prices. And so you have this question of why we're like oil price, and we're not talking about like oil prices were $10 and 90 and now they're $20. Like oil prices were higher then than they are now. Oil prices got up to almost $150 a barrel during this time period. So we've already covered one of the major reasons for that, right? Like these emerging markets with huge populations are kind of entering second world status.
And
third world.
Everybody knows that when you start developing and you become richer, you consume a lot more energy, right? Which is probably what's happening. It's not just energy commodities, though, right? It's oil and gas, but there's also are other commodities increasing in price during this time period?
Yep. So just to put it in context, for oil and then all the natural gas, coal, copper, aluminum, agricultural commodities, all is pretty similar. So it's a really pretty broad-based super cycle. I looked up how many, even though there's no definition, I looked up how many commodity super cycles have there been in the past. And the answer I got was that there was one in the 60s and that there was one like before 1900.
Huh. So pretty rare.
Yeah, very rare.
Credit cycle.
Right, very rare. It'd be interesting to kind of dig in on the one in the 60s. And like, I don't even know what commodities we would have been dependent on before the whale blubber, whale blubber commodity super
Not
cycle.
in the 60s. Oh, you mean like in the 1900s? Before the 1900s? Yeah.
But just to put it in perspective, so between 1986 and 2002, WTI crude prices averaged $20.46 a barrel, and they had a standard deviation of $4.93 a barrel. WTI never exceeded $41.07 before the recovery period that we're talking about started in late 2002. At the start of the recovery, oil price WTI was $28.96. During the recovery period, so kind of before it really fully took off into the the high hundreds, we're talking about an average of $48.85, so more than double the previous average. In the expansion period, we got to an average of $73.75. And in the bear market, interestingly, right, you'd think oil prices would collapse.
It goes up again, right?
Right, yeah.
I remember that.
It's an average of $90.96.
Yeah. It gets to 150 at some point during that time period, doesn't it?
Yep.
Yeah.
I remember I drove the most awesome car then. It was a dual exhaust black 2-door Tahoe with a grill.
This is before the Prius.
Before the Prius. I was cool before the Prius. This is why the Prius was such a hit. But I remember working at a summer camp in between freshman and sophomore year and getting paid and going to fill up my Tahoe at $150 a barrel oil and whatever gasoline prices were then. If I remember correctly, it was like $130 to fill up my car with gas, which was like 30% of my monthly payment at the summer camp or something.
Yeah. Sounds about right. I mean, in 2008, I was an intern at Marathon Oil, and that's peak oil. Like oil was hovering in like 150, 170. Goldman Sachs was saying it was going to go above about 200. Right. Fascinating. Front row seat.
To really drive it home, right? I said that prior to this period, oil prices were averaging in around $20 with a standard deviation of around $5. During this period, we're talking about an average oil price of $60 and a standard deviation of $26. You're talking about really high and really volatile oil prices, and this was true across commodities. So I think that's just kind of a relevant backdrop as we think about market cycles.
Okay, so interest rates came down. That's kind of the point, right? So interest rates are really low. In fact, they're lower than they've been in decades, which means, notably for the housing market, that there are a lot of mortgages out there with much higher interest rates than the current rates, which of course, we're all familiar now in this market, right? Like if interest rates come down, you're going to want to refinance. And so that's exactly what happens, right? And on top of that, you mentioned the global savings glut and all these, dollars that need to get reinvested into the US. And all that capital is looking for safe investments. And the treasury market's kind of tapped out. They're not just looking to invest in US debt. There's a ready-made asset class waiting there to kind of absorb all of that. And that's, of course, mortgage-backed securities. Massive market, lots of demand. And with interest rates this low, there's going to be a lot of borrowers looking to refi. So there was a massive refinancing boom, and it starts in 2002 and keeps going in 2003. And just to kind of put some numbers to it, there's $2 trillion that get refied in 2002, $2.5 trillion in 2003. Most of these mortgages were refinanced into conventional mortgages. So this is not subprime yet. The share of subprime originations in 2003 is only around 15%, which is pretty consistent with the previous decade or so. In fact, slightly lower than 1995 and 1997. And so originators like Countrywide that we talked about, they're making a lot of money, right? And they're posting really strong earnings. And they're not underwriting, a lot of subprime loans at this point. It's mostly conventional. AmeriQuest is an interesting character during this time period because they are a subprime lender. And it's a company that was founded by this guy, Roland Arnault, I think. Arnault? In 1979. It was actually a savings and loan. He was an SNL. And then they spin off AmeriQuest. And Arnault is a really interesting guy. He's kind of a boiler room type of character, born in France, moved to Montreal after World War II, then to California in the 50s. Super colorful, the kind of guy that would give out Porsches to his top salesman. So like that's the kind of culture that they're building at AmeriQuest. And they are very aggressive. They bought a ton of TV ad space. They had the naming rights to the Texas Rangers Stadium. And they built a pipeline to Wall Street investment banks. AmeriQuest becomes the largest originator of subprime, and they grow volume by 12x from 01 to 04. So they're originating $83 billion and generating about $8 billion of revenue as a result, mostly from fees. And their bread and butter was the 228 loan, basically a loan with a teaser rate really low for 2 years that then gets reset after 2 years. And there's prepayment penalties. The reason why they loved it is because, one, they could get a bunch of borrowers to do it because it's cheaper, but also because they will get paid a fee, obviously, when they come back and try to refi after the second year. So Arnaud builds his big business. He's worth $2 billion by 2002. He's super plugged in with politicians in Washington. And even though actually there were allegations of fraud and sort of predatory lending at AmeriQuest, he was kind of above the fray. None of this stuck. They just kind of keep going. They're also feeding the beast because the banks are hungry for subprime. They make a lot more money, manufacturing these. They don't have to compete with Fannie and Freddie. And there was a lot of investor demand for these because they could get sliced into tranches, into CDOs with really high ratings. And so the banks are making a lot of money. So there's a conversation in one of the books that I think is really interesting. It's sort of like, it's a perfect setup for the way this bubble is really going to inflate. And it's a conversation between some AmeriQuest people in a meeting with some Bear Stearns bankers. And the Bear bankers basically ask something like, how can you increase your volume? Because they want more of these subprime loans that they can securitize and sell. And the AmeriQuest people say, well, we can do 100% loan to value, and we can do a stated income loan, and we can do like 580 FICO score or lower. So this is no down payment, no income verification, really low FICO. And apparently the Bear bankers are like, yeah, let's do that. That sounds great. Go for it. And so the incentive structure, kind of going back to the first thing we talked about, is completely broken here, right? Because the AmeriQuest originators are getting paid a fee. They don't hold the loan. The bankers are getting paid fees. They don't hold the loans. So they don't care what the underwriting standard is. They just want the volume. So anyway, that's the subprime world. But at this point, it's still pretty low. In 2003, most of the mortgages are conventional. 85% of them are conventional. Subprime was about 15%. That all sets the stage, though, for what's about to happen in 2004, because the market ran out of conventional refinancings. The pool of conventional borrowers that could refinance at historic low rates is done. It's exhausted by the end of 2003. But the originators, conventional and subprime, the Countrywides, the AmeriQuests of the world, everybody, along with the banks, they had grown earnings significantly. Like Countrywide alone had grown earnings by 7x in the 90s. And then they grew them again by 6x in 1999 through 2003. So they needed a way to keep growing. And there was really only one way to do it.
Subprime.
Let's go. Yeah. So I at this point, I think it's worth reloading a little bit of the structure of the subprime kind of assembly line. I almost picture this as like a water brigade. Do you remember the cartoons with the little water brigade passing the buckets back and forth?
Yeah.
So the way I think about this, almost the way I visualize this, is that you have the originators out in the field doing the hard work of trying to find these borrowers, and they have these buckets of cash, these warehouse lines, these credit lines that they've been given by Wall Street, and they're just looking for people to hand cash to. And as soon as they hand a bucket of cash, they get back a little thing called a mortgage, and they kind of sell it off to a bank, and they, in exchange, get another bucket of cash so they can find more borrowers. The bank will take that mortgage and they will slice it up, they will repackage it and make all these little boxes that will get stamped by the rating agencies. Most of it, 80% of those are stamped AAA, which is as safe as U.S. government debt. And then they go find investors to sell those to. And whether it's, an endowment or a pension fund or a sovereign wealth fund in another country, that's where this is going. And those guys are not doing diligence at the mortgage level. They're just looking at the rating as a proxy for what this asset class might be able to deliver to them in terms of the risk profile and the yield. And they're not digging into, there was only like a handful of crazies that were actually taking 1,000-page prospectus and looking at individual mortgages and trying to assess the quality. So anyway, that's the assembly line. And at this point, heading into 2004, the economy had recovered from the brief recession of 2001. So now the economy is growing at north of 4%. Inflation had ticked up slightly to 2.9%. So the Fed starts raising rates in the summer of 2004. So they start at 1%, and they're going to continue raising rates through 2006 to, I think, 5.25%. Is that right?
That's right. Well, I think one thing that's worth mentioning here is we spent a lot of time talking about how high oil prices were and commodities in general. We spent some time talking about how housing prices are increasing at double-digit rates per year towards the end of this period. And so it's worth pausing and saying, like, why weren't interest rates higher sooner, given that the Fed's watching inflation and eventually raising because inflation numbers started to kind of be more consistently close to 3%. So it's just worth mentioning that, the core inflation that the Fed looks at then and now includes housing, but it includes something called owner's equivalent rent. So it doesn't include actual housing prices. It's more rent-based, which I didn't really get into studying why it wasn't increasing as fast as home prices, but it was acting normally. And then the commodity prices eventually, I think they just lag, right? I think the Fed generally views commodity prices as transitory, so it tends to not respond to spikes in commodity prices, but eventually it starts to show up in real inflation numbers. And what you get here is really the most aggressive rate hiking cycle in what I would consider modern history, right?
With the exception of now, right? Because I think the Fed has raised rates now.
Yeah, now, right? Sure,
yeah, exactly.
Sure.
So, but up to that point,
up to this point, yeah. So, like when I look at the history of Fed rate hiking cycles back to the since Volcker has been since the Volcker period, right, which is what I would consider kind of the modern economic period. I'm looking at 5 rate hiking cycles, and when you look at this one from from this one we went from 1% to 5.25%.
Yep.
So we went up 425 basis points, and then it's also relevant to consider how over what time period this rate hiking cycle happened over about 27 months, and when you look at it on like a per month interest rate hike per month basis also stands out as high.
I think what's also worth noting is that despite the Fed funds rate, the short-term interest rate being that low, the 10-year actually never goes down quite as much. Like the spread between the short-term rate, the Fed funds rate, and the 10-year is pretty wide at this point, because the 10-year declines a bit along with the rate cuts from the Fed, but it sort of hovers around the mid 3% range. But of course, as soon as the Fed starts hiking, it starts bouncing above 4%. And so it goes up by maybe like 100 basis points. Right. And I think that's what basically signals the end of the refinancing period. But now you have this conundrum if you're a Wall Street bank, and certainly if you're a mortgage originator, that you have to keep growing, right? Let alone like not shrink, obviously, but you have to keep growing. And all of a sudden, this giant market that you were benefiting from, that you grew by multiples, you don't have it anymore. So what do you do, right? And I think what's interesting is what happens next, because this is what's going to inflate the housing bubble. The house of cards, so to speak, actually gets built.
Right. In terms of how this rate hiking cycle is impacting the economy and what leads to what is ultimately called the Great Recession, right? That's what's coming next after this big run up. Remember, we talked about in the beginning that the consumer was levering up to kind of like unprecedented levels at this point, right? So you have a much, much more levered consumer, meaning a much more interest rate sensitive consumer.
Yeah.
And then you had like a triple whammy of impact to what is mostly low and middle income people, where you had the teaser rates that got reset. You had just the adjustable rates themselves, right? Where they were kind of
ticking up a
lower and ticking up. And then remember, we go all the way back to the S&L crisis for the reason that banks were allowed to charge essentially like a LIBOR plus structure, so a floating rate structure, to like a regular home borrower. So you had really this like triple whammy of increased costs.
You had this debt structure that was almost designed to blow up.
Right. On an already super, maybe not over levered, hard for me to say, but much more levered than they'd ever been in the past.
Yeah, with people that had very small, and this is pretty much the entire population, with very small cushion for expenses to go up by that much, right? So going back to the industry, the mortgage industry that had been built up around this. So you had this massive assembly line. that had gone from producing about $1 trillion worth of mortgages to producing more than $3 trillion by 2003. It's massively profitable. There's demand for what they're producing, right? Which is, I think, a key point here. Like, any industry, they're trying to amplify that demand, but borrowers want mortgages. And so there's demand both from the borrowers, obviously, people wanting more mortgages, and the cheaper the better, at least, short term. And investors want more yield, and they want more access to these products that they're pushing out that are AAA rated with great yields. The bottleneck is not demand for mortgages, it's underwriting standards, right? That's what's preventing potentially the party from continuing. And so if you want to build those products, you need the high quality credit risk that can be repackaged into those boxes, those tranches from CDOs and mortgage-backed securities. Underwriting standards are kind of the QC step. They're the quality control that makes sure that those products are actually what investors think that they're buying. But by 2004, we have this perfect storm. So you have this mortgage assembly line, this really big mortgage assembly line that is hungry to be fed with more and more mortgages. Because those mortgages are pooled, the rating agencies are stamping these as very safe. Housing prices had been steadily rising in the US for decades. And the aggregate probability of default in a diversified pool of mortgages is pretty small. It's very minimal. Investors and banks are very familiar with these products, and so they come to rely on them. There's this kind of a sense of security and familiarity in this market. But the raw materials are running out, and so the business is going to end unless they find more raw materials, right? And boy, are they going to find more raw materials here, right? So they're more than fine. They're actually going to create raw materials in the worst possible way. Because remember that conversation between Ameriquest and Bear that I was telling you about?
Yeah.
So the bankers told originators to go make more subprime loans, right? No down payments, no income documents, sub 600 credit score. That's what's going to make the difference here. They're basically going to start pumping as many of those through the system as possible. They're going to try to find anybody who they can to put them through the kind of machinery and create these mortgages. And the best part of all this is that Wall Street banks are going to dominate this market because they don't have to compete with Fannie and Freddie, because Fannie and Freddie can't buy these subprime mortgages to securitize them, right? And so they start pushing more and more risky mortgages through. These are one notch below conventional. So at first it's mostly Alt-A and A-, which is sort of just below, not quite subprime. But then they're basically all subprime after this. Just to pause here for a second, in my opinion, and maybe we can debate this, you and I have worked across financial services and investment firms in our careers, and I think it's too reductive to say that the industry knew that they were laying these landmines that would blow up the financial system. So that's my assertion. I mean, surely the incentives were terrible. The culture was ripe for short-term thinking, as it often is, I think, in the financial industry. Sometimes even predatory, all true. But I think when you're in the game, I think it's easy to lose the forest for the trees. And I don't think that even if you know that some of these things won't perform, you're not thinking that this is going to get to the level that it did. You're not thinking that this is going to scale up and potentially, spread kind of far and wide across the entire system and potentially bring it down.
Right. Yeah. No, I think people are just responding to incentives. And to me, the thing that, where I would, if I had to really reduce and finger point at one group, I'd actually point at the rating agencies, right? Because when you think about what the bankers were doing and what the mortgage-backed security, investors were doing and what the CDO investors were doing, is they were just buying ratings. Remember when I worked at GSO, for the first couple of years, I was the analyst in what was effectively a shale revolution mutual fund, right? And so our investors wanted us to buy the high-yield issuances of mostly upstream shale producers. And we had a mandate to buy certain amounts of certain ratings, and there was a lot of new issue happening at the time. And so we were just doing what our customers asked us to do, right? They wanted a certain exposure at a certain rating. And so if I had to really reduce this down to one group and like who really enabled it, I was going to say who should have known better, but they're just responding to incentives too. And so there's a little bit of a circular argument between like...
Yeah, for sure. You could argue that the banks should have known better because there's definitely an argument to be made that the ratings agencies were not staffed to evaluate these very complicated CDOs, some of which were CDOs of CDOs, and these pools of mortgages. And on top of that, you had these banks that were constructing, and not only that, but they were building the models, they were paying the rating agencies. So there's just this confluence of stuff. And I don't want to be like apologetic, or I don't want to be like, an apologist for the industry in any way, shape, or form, because I do think that ultimately the industry, Wall Street banks and the rating agencies combined, are probably the biggest culprit in terms of what eventually happens. But I do think that it's more nuanced than simply implying that there were just bad actors and that they made these decisions knowing that these things would blow up.
I agree with the caveat that I think things got really skewed by the size of the bonuses before the great financial crisis, right? Like if you and your peers are making several $1 million annual bonuses, then you're thinking very short term.
Yeah. You're going to find a way to get paid at the end of the year. And then to be fair too, like there's this philosophy, you got to put yourself back in the shoes of the early 2000s. There's a complacency that you've figured out a way through these, securitization products and derivatives, that you have figured out a way to not just move risk around the system, but to actually reduce it, right? Like that is the expectation. And in a lot of ways, that's why 80% of these CDOs end up being marked AAA, because you expect that if you compound the default rate of a single mortgage across a giant pool of geographically diversified mortgages, that the probability of even 1 to 2% of losses in that pool in aggregate is infinitesimally small. I think that is the philosophy. But the reality is that, on that kernel of truth, which on its surface is I think right, mathematically right, gets built this whole edifice that doesn't hold up, that is not logical, especially given the assumption that housing prices will never be correlated. Not that they weren't in the last couple of decades, but that they will never be correlated. And upon that assumption, all these products get built out that ultimately when housing prices all do decline at the same time, it just blows up. And so maybe to get back to kind of the storyline here, I think what's interesting, because there's a through line here of if all of these mortgages had been conventional, I think that logic actually would have held up and that assumption would not have broken. But the fact is that the profile of the mortgages that are inside of these securities are completely changing. And so if you kind of look at the data, by 2003, 22% of mortgage-backed securities are non-Fannie and Freddie. So let's call it private label. They're built by by Wall Street banks. So 22%. But by 2004, 46%. So double the share is put together by the Wall Street banks. And then by 2006, it's going to be 56%. And that giant market share increase, of course, is mostly non-conventional. It's not just subprime, but it's effectively non-traditional mortgages that have a much higher default rate than what is in these historical models that the ratings agencies and even the banks were using.
Did you get a chance? So I from my reading, I got the impression that the market share changed a lot, situation changed a lot, but the revenue and earnings of Fannie and Freddie, I don't think changed a lot because of how fast the aggregate market was growing.
That's right. Yeah, Fannie and Freddie were kind of struggling. I think Fannie and Freddie from 2003 to 2006, Fannie and Freddie are scratching their heads because they're not competitive. And remember, even though they have an implicit government guarantee, they are private companies with shareholders that have to post earnings. And so Fannie and Freddie are looking around going, what's going on? Right? And we are not competitive in this market. And they're actually looking for ways to be more competitive and to make more money. And interestingly, they're going to ultimately decide to invest in subprime mortgage-backed securities, not in terms of securitization, but in terms of holding them in their own books, like buying them from the banks and holding them in their own books because they yielded higher and they had better returns. And they do this at precisely the worst point when everybody else is sort of already, or at least the sophisticated players in the market have already seen the writing on the wall. And what's worse is that they thought that they were actually taking market share back, and that this was going to be a good thing for them, not just in terms of returns, but in terms of market share. And of course, ultimately, they're going to blow up. So even Countrywide, which remember they sort of prided themselves in originating only high quality mortgages and having really high standards for underwriting, they end up diving headfirst into subprime just to be competitive with all the other originators that are taking so much market share. They feel like they can't afford to cede market share to everybody else. And so of course they dive right in, And at this point, both sides of the market want this, right? The Wall Street banks and the originators want this. Investors want it. Borrowers are lining up to get these subprime mortgages. A lot of these borrowers are actually not first-time homeowners. They're people either speculating to flip homes or to get second homes, and they're doing these through more creative kind of mortgage products. So this push massively expands the amount of credit available for mortgages. But you got to remember that the supply of housing is inelastic, right? You can't just go out and build a house in a day to feed all of this demand for housing. And so what ends up happening is that you had a lot of borrowers with pre-approval letters ready to bid on houses, especially in hot markets. Places like California, Arizona, Nevada, Florida, Georgia, that had really good economic growth and job prospects. And you couldn't build homes fast enough. So everybody was competing for the existing supply. If you were a buyer, you looked at a house, and by the time you put in an offer, there were several other competing offers. So you multiply that across these markets, and the expansion in credit supply itself was driving house prices up. And that in turn meant that buyers needed to borrow more because housing prices were going up. So buyers are stretched, and that created even more subprime mortgage demand, right? If you could buy a house for $200K and you could get a conventional mortgage, but now all of a sudden that same house is getting bid up to $300K, now all of a sudden maybe you're out of your conventional mortgage range because you have, in order to have a 20% down payment, maybe you don't have that cash. So then it almost forced more buyers into the subprime market. So the more subprime grew, the higher prices went, and then again the higher prices went, the more subprime grew. And so you create this upward spiral, this kind of self-sustaining chain reaction that inflated the bubble. In a nutshell, that's effectively the dynamic that creates this giant run-up in housing prices, and that does so across pretty much every market in the U.S. So just to kind of put some stats, especially on those hot markets, from 2000 to 2006, house prices in the U.S. doubled on average, which is massive for a 6-year period. And in the California, Arizona, Nevada, Florida markets, which are kind of labeled the sand states, they were up by 150%. If you look at a town like Orlando or LA, prices were up 30 to 70% from 2004 to 2006. So to kind of put it all together, underwriting standards are getting worse. There's a ton of pressure on originators to increase volume to keep up the growth that they had experienced. And so, of course, people in the field start doctoring documents. The share of kind of fraudulent activity picks up significantly. There's one anecdote of a stated income loan where the loan officer submitted this package claiming that the borrower was a ferret farmer making $15,000 a month.
This is a very common profession in the early 2000s, ferret farming.
Yeah. In reality, it turns out she wasn't even that. She worked in retail. She made $1.5K a month. So a tenth of what was claimed. And that was pretty rampant across the whole mortgage market by 2005, 2006.
What happened to ferrets? Ferrets used to be much more popular as pets. I haven't seen a ferret in a long time. Are they illegal, or did something happen?
I don't know. The other thing is that credit spreads actually tightened. Did you see this? Credit spreads, so the difference between like the 10-year yield and mortgage rates at this point starts to actually tighten. So the cost of credit actually goes down during this period. So
right.
Credit is getting cheaper.
This is the global savings glut.
Yeah, with the global savings glut, and I think there's this general perception that everything is great, right? Like the great moderation, everything is great, things are going just fine. Sure, let me just go chase more yield. And so investors are almost like competing for each other for these securities, which is driving down the price that borrowers are having to pay for these.
Very good chance that everybody buying mortgage-backed securities and treasuries are using lots of leverage.
Yep.
To do it, right? So the tightening of spreads impacts them less because they're using 80% leverage to buy the treasury.
Exactly. Yeah. So if you're only using $100 to make $50 because out of that $100, 80 of those is debt, then you don't really care if the yield that you're earning goes down a bit because it's amplified. So where is the market by the end of 2006? So mortgage originators went from about $1 trillion per year before 2000 to about $3 trillion per year by 2003. it stayed at about 3 trillion from 2004 to '06, but the composition shifted from traditional mortgages that are relatively safe with really low default rates to non-traditional mortgages, subprime, Alt-A, etc. And there's about 1 trillion of these per year that are generated from '04 to '06. And the underwriting standards are just getting worse and worse from that time period, that 3-year time period. These trillions of dollars in mortgages were now everywhere throughout the financial system. Trillions in mortgage-backed securities, collateralized obligations. They were in bank balance sheets. So if you look at the bank balance sheets at this point, Lehman Brothers had $80 billion of exposure, plus or minus. Bear Stearns, $70 billion. Merrill Lynch, $60 billion. Goldman, $40 billion. You can kind of go through the entire list on Wall Street, and they were massively exposed to these mortgages, to these mortgage-backed securities. They're also in the originator balance sheets. So Countrywide had 90 billion of these on their books. AmeriQuest, 50 billion. They're on Fannie and Freddie's books. Each of them had 40 to 50 billion dollars on their books. They're going to buy more after this period, like we talked about. And they're also in pension funds, insurance books, international banks. They're pretty much everywhere. And remember, one of the key principles is that housing prices don't fall, right? That was a belief. And so it sort of underpinned this whole ecosystem. So remember those 228 loans with the teaser rates that we talked about that would reset.
Yep.
So by 2006, you had full data sets for the 2004 and 2005 cohorts, and you had a partial data set for 2006. And by that point, early defaults were quadrupling to about 4% for the 2006 cohort. So people are starting to recognize this, right? And as the whole assembly line starts to recognize this, now there's a giant pullback in credit. So less lending, less origination, because people are looking at these default rates and they're all exposed and they're a little bit worried. Not everybody is freaking out by the end of '06, but there's a significant pullback in credit, which starts to create a self-fulfilling prophecy, because the moment you start pulling back from these markets, it's almost like backwards what we talked about, right? There's less buyers bidding for those same homes, which means that the house price that you expected to get when you were flipping your house is now slightly lower. And that might end up causing you to default on your loan, or maybe when your teaser rate from 2004 gets reset and you can't afford your mortgage anymore, and you can't find somebody to roll it forward into another low rate loan, you might foreclose, which increases supply in the market. And so now you're in this downward spiral in a lot of these markets, and housing prices start to not just come down, but they start to crash. And so with that, originators had in the agreement, when they would sell these loans to be repackaged into mortgage-backed securities, there were agreements that originators had to take them back if the loans went bad early, and that's what started to happen. So, Countrywide and AmeriQuest and all of these originators start to have to take back some mortgages as they're defaulting and figure out what to do with them as they're on their books. They had less capacity to originate. Less mortgages, of course, means less buyers, and so that keeps feeding the whole cycle down and creates this downward spiral for pricing. So inventory levels start to go up. If you look at a stat, which is months of supply, so this is one of the critical stats that we looked at Divvy when we were gauging the health of a market. So months of supply is basically how long it takes to sell all the homes that are in the market at any given time, given how many homes are selling during that time period. The months of supply went from about 4 months in 2004 to about 10 months by early 2007. So market deteriorating quite quickly. And by December of '06, the people on the front lines, the big mortgage desks on Wall Street, and especially some of the big originators, they start seeing the writing on the wall. And, some earlier than others, but the first domino actually falls on December 28th of '06, when one of the major originators, this company called Own It Mortgage Solutions, filed for bankruptcy after being forced to repurchase a bunch of loans that were going bad early. And they lose their financing, so they have to file for bankruptcy. They're kind of out of warehouse lines. They can't make any loans, and they can't fund themselves. Housing bubble peaked in '06, and it crashed in '07 and '08. And to put it in perspective, by 2008, the prices of homes are going to go down to about 2003 levels. They're going to be down more than 40% peak to trough. So imagine if your house that you bought like 2 years ago went down by 40%. That is massive. So back to our timeline, should we pick it up with the scene that we said at the beginning? So the housing bubble peaked, starting to collapse, putting ourselves back in the action. You remember, you lead the mortgage desk at this bank. You lead the mortgage desk. You arrived early. You got no sleep last night. All the metrics in your dashboards as you look at the mortgage market are flashing red. Your model is screaming disaster, and it's not because of refs. Nothing is reffing out in your model. This is real. This is calculating properly. You're tripping over your chair. Remember, you're running out of your office. You're looking for the head of the bank's risk committee, and sort of subconsciously you realize like there's only really two options here. You either are going to try to offload the risk as fast as you can, or you're going to watch this bank, this institution's been around more than 100 years, go down like the Titanic. That's the scenario that is playing out.
Yikes. So what would you do?
I don't know. We'll see. We'll talk about it in part 2. Let's leave it there.
Cliffhanger.
All right.
Thanks for studying with us, everybody. We'll fast follow with part 2 in about a week or so. This is a new project we're trying, so if you like it, let us know by subscribing at crashesfm.com. That'll keep you updated on all the new episodes and also new topical articles.
Thanks for listening. See you next time.
See you guys.